When traders first dive into technical analysis, one of the earliest tools they encounter is the moving average. But not all moving averages are built the same. Today, we're going to deep dive into the exponential moving average versus the simple moving average, help you decide which truly suits your trading style. Now, let's be clear. Both SMA and EMA track price trends over time, but the difference lies in how they weigh price data. The SMA takes an arithmetic mean equal weighting for all candles within the period. For example, a 20-period SMA averages the last 20 closing prices equally. It gives you a stable, smoothed-out view. No panic, no rush. In contrast, the EMA gives more weight to the most recent prices. It's like a trader with sharper reflexes. If the market is moving fast, news, volatility, breakouts, the EMA responds quicker. And that's not just theory. Let me explain why that matters. Let's say you're a scalper or a day trader. Your entire edge might depend on entering just seconds before the crowd. In this case, the EMA might become your best friend. It adjusts faster to price reversals and momentum bursts. Think of a EMA strategy on the 5-minute chart. It hugs the price closely, giving tight entry and exit signals. But here's the trap. Its sensitivity can also create false signals in choppy markets. That's where many traders get chewed up, chasing micro spikes instead of waiting for confirmed moves. On the other hand, the SMA is ideal for swing traders and position holders. Let's say you're watching a 50-day or 200-day SMA on the daily chart. These aren't tools for catching micro reversals. These are your macro trend indicators, signals of a structural trend, not just noise. Large institutions often use the 200 SMA to define whether a pair is in a bull or bear phase. Price above it, trend considered bullish; price below, caution, or even short bias. But here's a nuance many traders miss. The SMA's lag isn't just a downside, it's a filter. It filters out emotional trades. It prevents overreacting. This makes it incredibly powerful for systematic strategies, where entries are based on discipline, not instinct. Now here's something deeper. A lot of traders ask, which is more accurate? But that's the wrong question. Neither is inherently more accurate. The better question is, which moving average fits your trading psychology? Are you reactive or patient? Are you looking for frequent trades with tighter stops or fewer trades with higher conviction? If you're retesting strategies with EMAs, try combining a fast EMA, like 8 or 12, with a longer EMA like 26 or 50 to build crossover signals. For instance, the 12 to 26 EMA crossover is a classic part of the MACD indicator. And when confirmed with volume and trend structure, it can be deadly accurate. If you're leaning SMA test zones like the 5-0 SMA retracement, especially on major pairs like EUR/USD, institutional algorithms are known to respect these levels because they reflect longer-term order flow. That kind of dual confirmation is what separates impulsive trading from professional strategy. So, which is better? The answer depends on how you trade, not what's popular. SMA gives speed. SMA gives stability. Choose based on your strategy's DNA, not someone else's. And if you're serious about mastering moving averages and building trading strategies that actually hold under real market pressure, it's not just in demo accounts, then it is time to take your journey to the next level. Join Innohedge today. Gain access to our strategy vault, expert breakdowns, and proven systems built for traders who want more than just random YouTube advice. We don't just talk about indicators, we teach edge. Now let's build smarter, data-driven trades together. Join us at Innohedge.